Bitcoin might not have topped yet, and if it has, no one could have predicted it. So in today's video, we're diving into 3 unconventional market indicators that tell a very different story from the charts you're used to seeing. We're going to take a look at some macro models and some popular global risk signals that have historically marked cycle peaks. And right now, none of them are flashing a classic top. So this isn't your typical Bitcoin analysis, it's a look at the bigger picture. So let's dive in. Today we're going to look at some unconventional valuation metrics for Bitcoin. So not my usual TA or on-chain charts that you're used to seeing. Instead, these are macro and relative strength models that, when you put them together, can give a very different perspective on where Bitcoin sits in its cycle. And what's fascinating is that each one of these has marked the major cycle turning points before, and right now they're all telling us something quite interesting. So the goal here, as always, isn't to say with certainty that Bitcoin has topped or that it will absolutely go higher, because markets never give us that kind of guarantee. But what these indicators do show is that whether a top would be obvious or completely invisible based on historical patterns. So if Bitcoin has already topped this cycle, then it would be one of the stealthiest tops we've ever seen, because none of these macro valuation models are flashing the extreme readings they usually do. So let's dive into the 3 tools we'll be using today. Let's start with the SPX DXY fair value model, because this one gives us a structured, macro-based framework for looking at Bitcoin's valuation. The way this model works is by measuring Bitcoin's relative performance against 2 of the biggest forces in global markets, the S&P 500 and the US dollar index. This specific indicator calculates a 6-month rolling return for each and then applies adjustable weights to reflect their influence, and then blends them into a baseline fair value return model for Bitcoin. What you then get is a smooth comparison between how Bitcoin is actually performing versus how it should be performing relative to these macro benchmarks. And the most powerful feature of this model is its deviation metric, which highlights when Bitcoin is trading far above or below that fair value line. You can think of it as a valuation spread. When Bitcoin's 6-month returns massively outpace the S&P and the dollar, it's usually a sign of overheating, and historically that's coincided with cycle tops. And on the flip side, deep undervaluations against this model have often aligned with strong accumulation zones. So to put this into context, in the last 2 cycles, whenever this deviation percentage has spiked into the plus 350 range, highlighted by red in the chart, it lined up almost perfectly with Bitcoin's cycle top. And these extremes reflected periods where Bitcoin's 6-monthly returns were massively outpacing both the S&P 500 and the US dollar index, signaling that the market was overheating relative to the broad macro conditions. In other words, it wasn't just a major Bitcoin price event, it was a reflection of the broader financial ecosystem reaching its peak risk-on sentiment. Right now, however, we're nowhere near those levels. We've been chopping sideways, the deviation has moved back into the green, and the market hasn't shown that explosive unsustainable divergence from equities or the dollar that has historically marked exhaustion. So from this lens, Bitcoin doesn't appear to have hit the classic cycle top, and the macro backdrop still suggests that there's further room for expansion before any extreme overvaluation becomes apparent. Now let's move on to the second indicator, which is the BTC to Nvidia relative strength model, which is quite popular amongst the retail crowd. And this one is a little different because instead of looking at Bitcoin against a broad macro benchmark, it compares it to another high beta, high growth asset, which is Nvidia. It takes the ratio of Bitcoin's price to Nvidia's price on a weekly basis and then smooths it with an EMA to cut down the noise. And on top of that, it plots a fast and slow moving average of the ratio to highlight structural momentum. And it can even overlay bands to show when Bitcoin is stretched too far in either direction compared to Nvidia. The point here is not to say which one is better, but to measure leadership, i.e. which asset is outperforming the other over time. And historically, this ratio has been a surprisingly good marker of Bitcoin tops. In the 2013 cycle, the ratio topped at around 2,000. In the 2017 cycle, it reached 3,000. And in the 2021 cycle, it peaked at around 4,000. So, simple logic would dictate that we'll be looking for a top of around 5,000 on this ratio for this cycle. But right now, we're nowhere near those levels. In fact, after bleeding relative to Nvidia for several years now, the ratio is only sitting at around 600. And that tells us 2 important things. Firstly, Nvidia has clearly been the stronger asset in recent years. its historic run driven by AI adoption and the broader tech enthusiasm has left Bitcoin lagging in relative terms. But secondly, for Bitcoin to reach the same extreme relative levels, like it's seen in previous cycles, we'd need a massive parabolic rally, and the BTC Nvidia ratio would have to climb several multiples higher. And historically, Bitcoin has experienced multiple X's during the parabolic phases, but reaching a ratio of 5,000 now feels a bit of a stretch to me. And part of that reason is macro-related. A backdrop strong enough to propel Bitcoin to those extremes would also likely benefit Nvidia, given its structural growth drivers and sensitivity to risk-on conditions. In other words, even if Bitcoin rallies aggressively, it's competing in the same macro currents as the other high beta assets, making it harder to see the kind of dramatic outperformance we've seen in past cycles. And I think this ratio eventually meets its keeper and becomes one for the history books. Now, the third model we'll look at is the copper to gold ratio, and this one comes straight out of macroeconomics and has been used for decades as a proxy for global risk appetite. So here's the logic behind it. Copper is an industrial metal that tends to perform strongly when economic activity is expanding. It's used in construction, electronics, manufacturing, so demand rises when businesses are investing and the global trade is healthy. But gold, on the other hand, is a defensive asset that investors flock to during times of uncertainty or geopolitical risk, or when central banks are just signaling monetary caution. So by dividing copper prices by gold prices, you create a ratio that essentially measures the market's risk appetite. When the ratio rises, it signals confidence in growth and a willingness to take on risk. And when it falls, it shows caution, risk-off positioning, and just a preference for safe haven assets. So this indicator here plots the copper to gold ratio, adds a longer-term moving average to smooth out the trend, and dynamically colours the line based on whether the ratio is above or below that average. So green readings indicate that copper is outperforming gold, signalling risk-on sentiment, while red readings show gold outperforming copper, signalling risk-off behaviour. And what's particularly interesting is that in the context of Bitcoin, is this ratio has historically aligned with cycle tops again. Whenever the ratio has breached the level of around 0.3%, it's coincided with extreme market optimism and the Bitcoin cycle peaks. But right now, however, we're nowhere near those extremes. Since the last all-time high, the ratio has trended lower, sitting closer to 0.1%. And one key reason for this decline is that gold has had a historic run over the past year, benefiting from persistent macro uncertainty and rate volatility, and remains one of the strongest demands for a safe haven store of value. Meanwhile, copper hasn't kept pace, reflecting cautious industrial growth and muted risk-on sentiment. The result is a ratio that remains subdued, suggesting that the kind of broad, exuberant risk-on behaviour that we usually see at Bitcoin cycle peaks simply isn't present at the moment. So let's step back and put all this together. The SPX DXY fair value model says that Bitcoin hasn't reached the type of extreme overvaluation levels relative to stocks and the dollar that has marked past cycle tops. The BTC Nvidia ratio says that Bitcoin is nowhere near the kind of relative strength peaks it's hit before, and we would need a parabolic rally to even approach them. And the copper to gold ratio shows that we're far away from the macro risk-on readings that have coincided with cycle blow-offs in the past. So each of these on its own is a strong tool, but together they form a pretty compelling case that Bitcoin hasn't displayed the kind of exhaustion that usually defines a cycle top. But could this time be different? Well, absolutely. Every cycle has its quirks, and no single model is perfect, especially ones this niche. And that's why I also say that if Bitcoin has already peaked, then none of us could have seen it coming, because the signals that normally scream a cycle top simply aren't there. And it's not just these unconventional valuation models pointing that out. My key on-chain metrics, which I personally lean on much more heavily for solid fundamental analysis, aren't flashing the kind of extremes that we normally associate with a top either. They just simply don't represent the kind of conditions that we've seen at prior cycle peaks. And for Bitcoin to have already topped, it would mean breaking not just one of these historical behaviors, but all of them at the same time. And that's not impossible, but it would be unprecedented. Now, that doesn't mean we should just blindly expect higher prices. Markets are probabilistic, not deterministic. And what these indicators do tilt is the probabilities. They show us that historically, Bitcoin tops have aligned with extremes in these unconventional valuation models, And we're not there yet, which suggests that there's more room to the upside, though it may take a parabolic rally to get us back to those zones. And at the end of the day, I don't use these kind of metrics as the foundation for my decisions. But for me, the backbone of my analysis is still on-chain and technical structure, and that's where I find the most consistent edge. But what I do like to do is look for confluence across multiple disciplines. If the on-chain data, technicals, and even some of these more unconventional macro models are all pointing in the same direction, that's where my conviction really builds. Because the truth is, markets rarely move just on one driver. They're a blend of fundamentals, sentiment, and macro forces at play. So when I see these signals line up across very different frameworks, that's when I pay closest attention. Not because any single one of them is perfect, but because when you put them together, the story they tell is much harder to ignore. So, to wrap things up, when we look at the broader picture, it's clear that Bitcoin isn't showing the classic signs of a cycle top just yet. From a macro perspective, the SPX DXY fair value model tells us that Bitcoin's performance relative to stocks and the US dollar hasn't reached the extreme deviations we've historically seen at peaks. In other words, by this measure, there's still room for upside before markets hit that kind of exhaustion. And then, if we zoom in on relative strength, the BTC to Nvidia ratio is far from the highs that coincided with previous cycle tops. Bitcoin hasn't entered that parabolic zone where it's overwhelmingly outperforming or outshining even the highest beta assets. And this suggests that, at least from a leadership and momentum standpoint, we haven't reached that all-in moment yet. And finally, when we consider macro risk appetite through the copper to gold ratio, the story is consistent. Risk on sentiment isn't peaking, and markets just aren't showing the exuberance that have historically lined up with Bitcoin cycle blow-offs. So taken together, all three of these unconventional indicators point towards the same conclusion. If Bitcoin has already topped, it would have done so in an almost invisible way, breaking down multiple historical behaviors simultaneously. So while nothing in markets is guaranteed, these signals collectively suggest there's still potential upside, and that the extremes that usually scream cycle top simply aren't there yet. It's not a guarantee for higher prices, because as we saw in my latest video, the case for a slow bleed out is very real. But nevertheless, it's a perspective worth keeping in mind as the cycle continues to unfold. If you're serious about Bitcoin analysis, my full custom indicator suite is now live. Built for investors looking to gain an edge through deep cycle signals and advanced on-chain insights. It's available now through the link in the description, where you'll also find my free newsletter. And if you found this valuable, hit the like button, subscribe to the channel, and turn on notifications so you never miss an update. And I'll see you all in the next one.